Well, first of all, there's been a lot of reform. It's gone in the right direction. Structural reform we've got happening in the UK by way of ring fencing, which I think is a good thing to do, but it's not happening anywhere else, so that's a bit disappointing. The issue I'm most concerned about is how I believe we need to go a lot further in terms of beefing up the equity capital in these banks and other financial institutions, whereas the official world, globally, and now here in the UK with the Bank of England, says, no, where we've got to is just fine. I think it's a long way short of fine. It's a very strange thing. People in the financial sector, in the banks themselves, and the regulatory community, with some exceptions, but the consensus among them is, we've done very well, we've got to a good place. The opinion of economists outside that group, again with some exceptions, is, wait a minute, you know, you're not even halfway there. We should be going a lot further. And for such a big public policy question as how safe to make the banks, which is so important for how the market economy works, to have these different groups, both sort of expert groups in some sense, you know, a long way apart is itself quite an odd thing. I feel that the economist group have much the best of this argument. I think there's some very low cost, even free insurance to be had out there by, over time, gradually, not in a sudden way, building up those equity buffers. And then the odds of another severe crisis would be reduced. You can never say never, but if and when the next one hits, we'd be better placed to withstand it. The question here is the proportion of shareholders' funding, equity funding, in the funding mix of a bank. What minimum percentage should that account for? Or to put it another way, how large a multiple of that shareholder equity capital should the banks be allowed to grow to? And even after all the reform efforts, big banks can still go 30 times leveraged, or the very biggest perhaps 25 or so. Now the academic view is, well, wait a minute, you shouldn't be going more than 10. This is way too much. So it can boil down to a question about that number. Now, what are the costs? What are the benefits? The benefits are you've got a safer system, better incentives, better decision making. If and when the next crisis hits, you're better placed to absorb the loss. The cost, well, it's costly to the banks because there's a whole set of tax reasons, subsidy reasons, and the rest of it. Well, it's a costly form of funding for them, but for society, well, it's not so clear what those costs are, provided you phase it in over a good length of time. I should first of all confess that before the crisis, I wasn't into these issues. I think most people thought, well, the regulators and everyone will have sorted that out, which turned out not to be the case at all. And I think one of the lessons for economists is we need to think much more carefully, and it should be in the mainstream thinking about the financial system. My own thinking, I chaired the ICB. We had a dilemma on this issue because we felt that the global baseline, global regulation was not strong enough, but we were making recommendations, of course, just for the UK. And there's a limit how far one country, even a sizable one like the UK, can go above the global baseline. So our recommendation was for the British retail banks, and with retail there's less of a risk of all the banks migrating somewhere else. We wanted quite a significant chunk over and above the global baseline. At the same time, we would have said that the global baseline itself, you know, should have been way higher, but of course we didn't have a say in that decision. Well, you look at who's having the better of that argument when you line up the costs and benefits and do the analysis. And I think the official view is actually left a bit stranded. I think the weight of argument is that we haven't gone far enough. And because the economy generally is in a calmer state than it was in the years immediately following the crisis, there is an opportunity to go further and build it up. I mean, it could be done. I think there are political reasons why it's difficult, but there's no technical obstacle to do it. So that's what I wish we would do and have more momentum in this debate. Problem now, since we're 9-10 years on, people talk about the pendulum swinging back, and you see this with the new administration in the United States, for example, that it may be things are pulling back when, in my view, we should be pushing on, pushing forward. I'm not saying, and I don't think anyone is saying, oh, there's a mega crisis just around the corner. It's saying, look, we're in a reasonably calm situation at the moment, though quite a lot of debt issues are building up in the world economy. But let's take this opportunity, let's build on the progress that certainly has been made to go a number of notches further. And here in the UK, the Bank of England could have done exactly that 18 months ago, but I very much regretted they didn't do as big an add-on for the equity capital of the big retail banks here as they might have done. So I'd say it would be awful if we had a repeat. And in some ways, I think it would be even worse, or could be even worse than last time, because monetary policy is, at the limits. You can't do that again because we've already used all the ammunition, if you like. And the political consequences of the rise of populism in various places that we've seen, I think a lot was to do with the financial crisis. Again, if you had another problem in the financial system well within living memory, I think it could be really, really calamitous, not just in economic terms, but in society and politics more generally. So the stakes are very, very big here, and I think it's important, therefore, that this issue gets more prominence. We have the policy debate, let the best argument win. I think that's pointing to a need for more equity capital, and let's do it. Well, of course, I'm not at the table with them. I think in the years immediately after the crisis, you had a pretty firm line taken in the UK and with the then administration in the US and in Switzerland too. Now, it's not entirely a coincidence because the Swiss had two enormous banks in relation to the size of the Swiss economy, just as we in the UK had some huge banks in relation to our economy. So the too big to fail issue is particularly prominent in economies like ours. But now the Bank of England is taking a rather different line, saying no, where we've got to is just fine. They would point to the new resolution regimes, the bail-in debt and all these issues, saying actually we can lower our estimate of how much equity capital is needed. Now, I think that's the wrong approach. I like the bail-in debt resolution regimes. I would see them though as a complement, an add-on, not a reason to lower the equity capital requirements. So, but let the debate continue. Let's have one.